risk and return. So this topic basically analyzes stocks to calculate the expected returns as well as the variance, standard deviations of assets. So a given state of nature or the state of the economy, strong, mild, slow, moderate, and strong growth. Then we have two limited companies, Misapa and Kasuba. So these are both seasonal businesses. So we want to calculate their expected returns. To start with, whenever we're not given probabilities, we assume equal probability. So we count the number of states of nature, 1, 2, 3, 4, 5. So basically, in this case, we're going to divide 100 over 5. So we divide 100 over 5, we're going to get 20% of each as a probability. So meaning this probability here will be 0.2, 0.2, 0.2, 0.2, 0.2. So if there were 4 probabilities, we would divide the 100% probability divided by 4. So we're dividing by 5 because we have 5 states of nature. So as usual, this is how we calculate. So after dividing the 5 by 100 by 5, the 20%, the probability for Misapa times the return. So we're going to multiply these ones. So 0.2 times 10% here, or 0.10. Just converted them into percentages. So 0.2 times 0.10, we get 0.02. 0.2 times 0.04, we get 0.08 negative. 0.2 times 0.04. So we calculate each of them, multiplying the probability and the return. So then you total up, our total value is going to be 0.044. So 0.044, if you want to put it in percentage, you multiply by 100, so 4.4% is expected return for Misapa. All right, to calculate the variance, we're going to subtract from each of the returns the 0.044. So we spread out the probabilities, 0.2, and the returns 10%, 4%, up to 20%. So I just brought down the expected return of 0.044, subtract from the return, so 0.10 minus 0.044. Then I square this answer. By the way, whenever I square any negative or positive, it becomes positive. 0.044 multiplied by 0.0144. Are we following? Are we moving together? Especially for those that have not done this topic before.
Yes, Mr. Collins. Sorry to ask you. There was another sum similar to this, but then I think, I don't know whether it's 2 ways of doing it, whereby you add the total numbers just on the question, and then you divide by 5. Is it another way, or that?
That one is finding the average returns. It's a different, it's not another way, it's a different question. Okay.
Oh, okay.
Yeah.
Thank you. Okay.
So we subtract and we square R minus expected return squared, then you multiply by the probability. Same applies here. We subtract the expected return from the return itself, you square times the probability. The total is called the variance. So after totaling up, we get our variance, which is 0.06716. So this is called our variance. So we do the same for the other company, Kasuba. The probability of 20% by the return itself, probability 20% by the respective returns, the total scored our expected return for asset B or asset Kasova. And find the variance by doing the same. After getting the return that we calculated here, 0.02, we subtract from each of these returns and we square it. After square it, we multiply by the probability 0.2, the total scored the variance. So in this case, we found our mean or expected return for Masupa as 4.4, since we found 0.04, and the variance at 0.067. And the mean summary for Kasuba as 0.082, this one, which is the same as 8.2%, or the variance for Kasuba is 0.016, which we just found here, or 0.16%. So this is how this question was supposed to be answered in relation to finding the mean and the variance. Are we together? Are we together on the first part, everyone?
Yes, kindly show the solution again.
All right. So if this question comes, this should be one of the easiest topics in this course. Please don't leave it out. So now the covariance, we're just interested in getting the probability and this column for asset Kasuba, then this column for asset Masopa, and multiply them together. This column. So this is how we calculated the covariance. Covariance basically looks at the direction that your assets are taking. So probability, return, expected return for Masupa, expected return for Kasuba and Masupa. So multiply this by that, the total. This by that, the total. And do the last one, you sum them up. So this is what we call our covariance. So the covariance is between Masupa and Kasuba. We're getting 0.02144. So this is our covariance. So the question further on went to ask for covariance and what? Correlation. So the formula for correlation is actually covariance over standard deviation for A and B. So in this case, our M and K, we find their standard deviation. Since the variance for Masupa was 0.067, we just square root it to find the standard deviation. Likewise for Kasuba, we square root and find standard deviation. So these are the standard deviations that I put here. And multiply this by that and divide the covariance we just calculated. So here we're looking at what? The correlation. So this is how we calculate the correlation. Okay. Is that clear? Are we moving together?
Yes.
Mr. Collins, sorry to bother you. Why have we just taken this is it the variance, the last one, the 0.21114 divided by the 0. When we have found 2, why are we doing that? Because I'm looking at that we have solved for 2, is it JM and JK, but we have just taken only the 0.2114 divided by the standard deviations.
Covariance is for 2 assets. You can't find the covariance for 1 asset. So this one was return and expected return for Masupa, and this one was a return for Kasuba. You multiply by the respective probabilities. So you get this. So this is the covariance for M and K for both of them. So the formula for correlation is what? The covariance for both of them divided by their standard deviation for each of them. Okay, A and B. That's how it's moving. You get, so this covariance was not for one, it was for both of them. That is the one here we have. And the standard deviation for Masupa was after we square rooted the variance here, 0.82. The standard deviation for cassava is after we square rooted this here, 0.04. So we just multiply these two, 82 and 0.4, then we divide it into 0.00. So this is the correlation. I don't know if I've answered.
Oh, thank you. I think I had only that thinking that you only do just the what do you call it, covariance or what? You just divide the standard deviation and what do you call this? The covariance. I think I was late into another sum, but I think that one didn't have two, I think, comparisons. I think that's where I think I'm coming from. But thank you. This is clear.
Yeah, so in this context, we must understand that covariance is there to measure the direction or relationship between these two risky assets, cassava and Masupa. So covariance would indicate the strength, it will indicate the direction of these two assets. So if you get a positive covariance, it means that the returns of these two assets are moving together. If you get a negative covariance, it simply also suggests that the returns are moving inversely. So these covariance are actually calculated by weighting these products and differences between the variables and their respective means. Correlation, on the other hand, we're looking at a standardized measure here, which determines the strength and the direction of the relationship between the two variables. And corporate finance, correlation, unlike in QM, is usually used to analyze these same returns on different assets, how they are moving in relation to each other. So correlation should always be expressed as a coefficient between the ranges -1 and 1. So if we have a positive correlation, what does it mean? That these assets are perfectly in a positive relationship. If they're negative, they're perfectly in a negative relationship. And if it's 0, they are not related at all. So they have a very similar use, also we're dividing in there. So correlation will help us understand the benefits of diversification. And now you should know the benefits of diversification in portfolio management. So both covariance and correlation, these are essential tools in portfolio management, in risk assessment. They will provide you the relationship between these two assets, which is crucial for decision making in corporate decision making. I hope that is clear, just to add on what we are discussing here. So we have done part 1, part 2. This question was nice. Now we're taught that suppose on combined portfolio, we are given 50% events made in each. What is the portfolio expected return and standard deviation? All right, so this is what we do. So since we're given the weight, 50% in each, 50%, so we just calculate 50% of the return for Masupa and 50% of the return for cassava. Just multiply them and weight them. So we're going to get 0.063, which is 6.3%. That is our weighted portfolio expected return. Of course, sometimes you'll be told that, for instance, cassava was 60% weight to investment. They will not give you the other one. So just know that if this is 60%, the other one is 40%. But anyways, at least you know what I'm talking about here. Are we all clear on how to calculate this portfolio return? Simply weight on cassava, expected return on cassava, plus weight on Masupa, expected return on Masupa. Then we just multiplied them and found this average. Now, how do you find the standard deviation? Portfolio standard deviation has its own formula. We are given this formula: weight on A, variance A plus weight on B, variance B plus 2WA, WB, covariance AB. So it's a long formula. Then the standard deviation is going to square root this answer. So what was the weight on A? 0.5. The variance on A, 0.067. weight on B, 0.5, variance 0.016. Covariance for both of them 0.002114. Then computing it together, 0.5 squared, I'm not squaring the variance, already squared, plus 0.5 squared. I'm not squaring the variance for B. And here, the 2 is part of the formula. 0.5 are the weight, the covariance will be calculated. So we're going to get the final answer of the variance as 0.02. When we square root it, we get 0.0468. In percentage, this could be 4.68% if you want. But it's a portfolio variance. Can we follow this? Are we together?
Yes, we are. The sum is too long, eh? How
Yeah,
many marks is it?
this carries about, I think, 6 marks. So when discussing a portfolio, we know that it's a mixture of more than one asset. So when we're talking about portfolio variance, what are we talking about? We're talking about the portfolio, the measure of how the returns of the portfolio fluctuate with respect to their mean. So it's a weighted sum given by that formula. Essentially, it usually accounts for both an individual risk and the extent to which the returns of the assets move together. So if you have a lower portfolio variance, means you have lower average risk. Similarly, portfolio standard deviation is the square root of the variance. It represents the degree of dispersion of the returns in that portfolio. So if you have a higher portfolio standard deviation, it means that there's higher risk that is associated with that. So a lower standard deviation means there's stable or less volatility. When we're discussing a portfolio expected return in finance, is another key concept which measures an anticipated return on the portfolio investment. So we weight them to find the actual corresponding proportion of the total investment. Then we're doing individually, now we are weighting them. So by weighting them, investors want to assess the potential profitability, which is based on the performance as a whole in terms of the entire portfolio. So it is very crucial for investors to make informed decision when it comes to asset allocation, portfolio management, and it will help them really to align their investment strategies with their financial goals and their risk tolerance. We know we have 2 types of investors, 3 in fact, the risk averse, risk seeker, and risk neutral. So this is very, very important. All right, so we are done with question number 25. Question number 26, those who got the pamphlet, this is a different one because there are many questions. So I've done a number of pamphlets, so there are more than 5. So a senior manager at Zambia Airways, you're authorized to spend up to 400,000 for projects. The 3 projects you're considering to have the following characteristics. Project A has an initial investment of 280 cash flows. Year 1 is 190, year 2, 170. And the plant is an expansion project. Project B, an initial 390, year 1, 270, year 2, 240. And this one is a new project development. And the project C, initial is 230, cash flows 160, and 190 for year 1 and 2 respectively. So you're asked to calculate the net present value, payback period, and profitability, and give a critique. So this is question 1 of your exam on capital budgeting. So the initial for project A, we usually put it as a 0 because that is your initial cash outflow, ICO. So our discount factor, we've been given the percentages, to work with. So we're told the discount rate is 10%. So you go on the table, 10% under the present values. You know how to use the tables, isn't it? So when you got 10% under 1, under 0, it's a 1. 10% under 1, 0.909. 10% under 2, 0.826. You multiply them to discount these values. So here we have 172 and 140. When we add and subtract to 80, for project A, we're getting a 3130. Do the same for project B. So let me finish with project A. NPV is how you get it. Are you together on the NPV?
Yes.
Then the sum of the positive of the cash inflows is called our present value. Okay, so when add this and that, we're going to get 313,130. So we're going to divide this one divided by the initial cash. So profitability index is sum of the present values over the investment. So 313 over to 80, here we get 1.12. And the criteria for profitability index is that it should be higher than what? 1. Criteria for NPVs should be positive. So far, the picture here looks good. So for payback period, we need to know when we are going to receive our initial cash outflow. So when you bring your 90 there, we add 90 plus 170, we get 360. So payback period, we need to look first within this range, where is the amount going to be paid. So the 284 falls between these two amounts. So this is called our A. This is called our B. Called our C. It's called our D. The payback period is simply A plus B minus C over D. Our A is the year, best year within the range. So we have 1 there. Then 280 minus 190 divided by 170. Or alternatively, without even having the formula, in which period is the amount going to be paid? It's between period 1 and period 2. That is 1. We pick 1. So 1 point something. Then the 190, how much is remaining before we get our amount paid? So we have a 90 to get to 280. Then the next cash outflow will be what we'll be dividing. Divide by 170. So this gives us 1.053. So this is our payback period. Please, if you want to put it in months, you multiply this one by what? By 12. You don't say 1 year, 5 months. No, it's wrong. If you're not sure, just leave it as 1.53. So we do the same for project B. The cash flows, we go to 10%, that is 1. These are the same cash flows. And we multiply these figures there. We get our total present value. We subtract the initial cash. This is our NPV, which is 53,000. So whenever we both have two positive NPVs, you pick the one with a higher NPV. Already here we had what? 3,000. Here we have what? 53. We're doing fine so far regarding NPV. Then we divide this is 452, 670. We divide this by the initial cash inflow. So here we divide this in there. We're going to get 1.16. So comparing, this is 1.12, 1.16, we're better off at B already. Then to find the payback period, we do the same. 270, bring it there. So add 240, we have 510. So the amount will be covered within these two periods. So our A is 1, then the difference here, 390 and 270 divided by the actual cash outflow, 240. So here we're going to get 1 plus 1.5. So this is 1 plus 0.5, this is 1.5. So this is going to take us about 1 year, 6 months. So on payback period, we've been beaten. Okay. So project.
Mr. Collins, sorry. The payback, I just really want to understand the concept, and maybe I'm understanding it in a different way. I understood that we are supposed to be subtracting and then finding which year. Can you help me get the better understanding of this?
So for payback, there are a number of formulas that most people would use. So whatever you know, perhaps think is also correct. So it's done differently. For instance, if my initial amount was 100, then here I have what? 40, and here I have 30, and here I have 20, and here I have 40, and here I have 50. So these are the actual cash flows. I'll go to the cumulative cash flows. I'll start with the 40 here, plus 30, which is 70 here, plus 40, I'll get what? 110, plus 50, I'll get 160. So my formula says we need to know where the 100 will flow. The 100 will flow between 70 and what? And 110. Are we together on that point?
Yes.
So meaning my A will be here. Okay, my B, my C, and my D. Make like a triangle like this. Triangle, a diamond. So A plus B minus C over D. That's the formula I usually use. So my A is what? 2. My B is 100. My C is 70. And my D is 40. So the payback period will be 2 plus 30 over 40. So this will be 2.75 years. That's how I quickly calculate it. You get it?
Yes, thank you.
All right. So here is where we are. Then we go to project C, the same, the discount factors. We calculate our NPV 72,000. Then we add these ones up, we're getting 302. We divide 302 over 230. We're going to get 1.31. So this one, payback is the NPV is the highest to start with. Profitability index is also the highest as we speak. Payback period. So we're looking at 230 here. So look between here and here, the 320. So this is our A, our B, our C, and our D. So our A is 1, our B is 230, our C is 160, and our D is 190. So here we get 1.35. So this one has actually the shortest payback period. So if we're going to analyze them here, NPV, C is the highest. Number 1, number 2, number 3. When you look at profitability index, this is number 1, number 2, number 3. Payback, we choose the minimum. This is number 1, number 2, number 3. So in all categories, C has been ranked, best. So you can rank them as follows. So you can even make your comment based on that. So C outperformed all the 3 in terms of NPV, IRR, of a bid index and the payback period. Is that clear?
Yes, sir. Can you please go up a bit? I just want to see the solution there. Yes, there. Thank you. I've captured. Thank you.
All right. So this is how this question was supposed to be answered. And we are done with our 25 marks. All right. So we think can end here. I've covered what I needed to cover today. These I've already done. We did this one. There's unfortunately no one who got the answer except those ones during the day who managed to get this answer correct for what's this? Stock valuation. Let me just close. So we told that Drake is dealing in electricity. They are willing to pay 4.75 1 year from now. Investors believe in starting with a 15% growth for the subsequent 5 years and 3% thereafter. They have an expected rate of return of 8%. What is the value of stock today? So it's starting from D1. So you can calculate the future value and discount them. So D1 will help us find D2, D3, and D4, and D5. So when you apply D1, 1 plus growth, we get the value of D2, the value of D3, value of D4, value of D5, value of D6. It ends up to value of D6. So for that growth, because the 5 subsequent years, 1, 2, 3, 4, 5. Then for each of these ones, we're going to discount them with what? 15%. So 15% here. All right, so this one will give us the value of stock for the first 5 years, which was, I don't know, I don't remember, but I was using a number line. So ultimately, I told you, gave you the answer. It's supposed to be 24.5 or 49 for those of you who were doing the calculations. I think you remember this question. I would appreciate you redo it because
Yes, I remember it.
yeah. So take your time to redo it. I'll need the
I
solution.
had a question though, sir. Just up there, why did we put up to D7? Why did we have to calculate up to D7? Well, we knew that maybe, okay, anyway, I've seen it here, but then I was looking at the question, I think on my own, I was asking myself, why did I have to go to D7? And then secondly, does it mean when we're given such questions, you will start from, as you're saying, we'll write it the way it is, D1 to D7, but then when you are counting, I think you're starting from D2, if I heard you correctly, you started like D2, 1, 2 to 5. Is that the concept or always
the subsequent 5 years? So it's from D1, D2, D3, D4, D5, D6. Because we're going to count 1, 2, 3, 4, 5, 6, 7. We're only getting to D7 because we need to use Gordon. But here, this is 1, 2, 3, 4, 5. The 5 ends in the 6. D7 is just for using Gordon's method to calculate the other phase. Otherwise, this was inevitable because we're starting from D1. If we're starting from D0, we'd have done it the normal way. So listen to my video again and see exactly what I did when I was explaining the projections using the number line.
all right?